Now, a great starting point to understanding stocks and shares is to understand the indexes that combine these stocks and shares that you're probably going to be trading. Now, the FTSE 100 index is a combination of the top 100 firms traded on the UK markets. It sums their value and you end up at a figure of 6,157. And what this figure tells us, it tells us on average how all of the companies in the UK are doing. So in a time of recession like right now, due to the coronavirus probably, we're going to be experiencing a massive downfall in the average prices of all the stocks in the world. And the FTSE 100, as you can see here, has had a massive fall from when coronavirus started to now as we are recovering from it. Now, the reason why it falls is because when the coronavirus came, pubs closed, airlines shut down, and obviously when airlines shut down and pubs closed, they're making no profit. When they make no profit or revenue even, investors don't demand the stock, their share price falls. And essentially when their share price falls, as the FTSE 100 index is an average of all of these companies, the index as a whole falls. Now this relates to why the FTSE 100 is a great kind of indicator for economic performance, because it does tell you how well the economy is doing, how well it's been doing in the past. And you also have many other indexes like the FTSE 250 index, which does a similar job to the FTSE 100 index, except now, as you can see here, we are looking at the 101st to 350th largest companies listed on the London Exchange. Now, over time, companies become more valued, less valued, and they move in and out of the FTSE 100 index, 250 index, 350 index, and all of these other indexes you can see right here are listed along the top. There is so many different indexes that can be used in industry-specific indexes or, mining companies or penny stock indexes. And you can actually buy into these index funds. So I could buy the index of the FTSE 100 if I believed that it was going to go back to its pre-coronavirus levels of 7,450. I could buy 6,000. I can buy in at 6,154 on a broker site, and I could then hopefully ride the wave up until 7,500, and then I would make 7,500 minus the price I bought it at, 6,154 profit. So about £1,300 profit if I bought one share in the whole index. Obviously, the American index is the Dow Jones. It's exactly the same as the FTSE 100. The whole concept behind it is, I should say. And you can see straight away that the Dow Jones, you're probably wondering, why is it valued so much higher than the UK one? Now, on average, the US firms like Tesla, Amazon, Apple, they're $300 a share, they're $2,000 a share, they're $750 a share. And that is essentially why the value of the firms in the Dow Jones is so much higher on average than the UK's, that the combined sum is higher, and hence the Dow Jones Industrial Average is a higher value than the UK one. Now, obviously, one thing to remember is that, in regards to stocks and shares, it doesn't matter about the value here. It just matters about the percentage. So although the Dow Jones fell 147 yesterday relative to the FTSE today of 61, the FTSE, even though it only fell 61 and not 147, it's worse that this was a bigger fall because it was 0.99%. That's almost 1%. Whereas with the Dow Jones, it was only 0.5% really. And you can see here that the market cap is 2 trillion on the FTSE 100 relative to the Dow Jones of 8 trillion. We're going to talk about the market cap. We're going to talk about dividend yield and all the other stuff that Google information portrays in the next episode. So let's jump into talking about some big companies like Tesla, Apple, Murphy's Oil, and I'll see you in the next episode.